In the basement of the Federal Reserve Bank of New York, beneath 60 feet of solid rock, sits a vault containing more gold than anywhere else on Earth. But there's something most Americans don't know about the gold their government owns. Something that could change everything about our economy, our currency, and your financial future. The United States Treasury holds 8,133 metric tons of gold. That's more than Germany, Italy, and France combined. But here's the shocking part. On the government's books, that gold is valued at $42 per ounce. Not the current market price of $2,900, $42. The same price it was locked in at over 50 years ago. That means the government is sitting on assets worth $760 billion, while only accounting for $11 billion on their balance sheet. $749 billion in hidden value. And Donald Trump's Treasury Secretary just announced they're planning to unlock it. On February 3rd, newly appointed Treasury Secretary Scott Bessent made a statement that sent shockwaves through financial markets worldwide. During a press conference announcing the U.S. Sovereign Wealth Fund initiative, Bessent said something that most people missed. We're going to stand this thing up within the next 12 months. We're going to monetize the asset side of the U.S. balance sheet for the American people. Financial analysts immediately understood what this meant. He wasn't talking about selling government buildings or auctioning off military equipment. He was talking about gold revaluation, the systematic repricing of America's gold reserves from their artificial $42 valuation to current market prices. This would create the largest single asset revaluation in American history. But this isn't the first time an American president has used gold revaluation to solve a financial crisis. In 1933, Franklin Delano Roosevelt faced the Great Depression, massive deflation, and a banking system on the verge of collapse. His solution was radical. First, he made it illegal for Americans to own gold. Executive Order 6102 forced citizens to turn in their gold coins and bars to the government at the official price of $20.67 per ounce. Most Americans complied, trading their gold for paper dollars. Then Roosevelt did something that changed everything. After collecting the nation's gold, he revalued it overnight from $20.67 to $35 per ounce, a 69% increase with the stroke of a pen. The government's gold reserves went from $4 billion to $6.8 billion in value. They created $2.8 billion out of thin air just by changing the price. But here's the key. The debt the government owed was still denominated in dollars, those same dollars that were now worth less relative to gold. Roosevelt had effectively reduced the real burden of government debt while creating massive new assets on the Treasury's balance sheet. Today, the numbers are far more dramatic. The United States government officially holds 8,133 metric tons of gold stored primarily at Fort Knox, the Federal Reserve Bank of New York, West Point, and the Denver Mint. That's 261.5 million troy ounces. At the current statutory price of $42.22 per ounce, this gold is valued at just over $11 billion on government books, but gold is trading at $2,900 per ounce in the real world. At market prices, those same reserves are worth $760 billion. The difference is staggering. $749 billion in unrealized value sitting in government vaults, artificially undervalued by a pricing mechanism established in 1973, when Nixon completely severed the dollar's link to gold. Here's why this matters now more than ever. The United States faces a debt crisis that traditional solutions cannot solve. The national debt has reached $36 trillion and growing by $1 trillion every 100 days. Annual interest payments on that debt now exceed $1.2 trillion. That's more than the entire defense budget, more than Medicare, more than anything except Social Security. The government spends more money just paying interest on old debt than it spends on the military that protects the country. This is mathematically unsustainable. You cannot run a government when interest payments consume an ever-growing share of revenue. Yet raising taxes is politically impossible. Cutting spending is politically impossible. Default is economically catastrophic. But gold revaluation offers a fourth option, a way to generate massive government revenue without raising taxes, without cutting spending, without defaulting on debt. Trump's team isn't hiding their intentions. The signals are everywhere if you know how to read them. Beyond Bessent's February 3rd announcement, there have been multiple indicators that gold revaluation is being seriously considered. In May 2025, the Financial Accounting Manual for Federal Reserve Banks was quietly amended. Section 2.10, dealing with the gold certificate account, was updated to clarify that the Secretary of the Treasury is authorized to issue gold certificates to the reserve banks to monetize gold held by the government. This technical change might seem boring, but it's the legal foundation for revaluation operations. The regulatory infrastructure is being put in place. Then there was the mysterious tariff incident that rocked gold markets worldwide. In early August, the Trump administration announced a 39% tariff on imported gold bars weighing 100 ounces or more. The announcement specifically targeted Switzerland, which refines approximately 70% of the world's gold. Gold prices immediately spiked to an all-time high of $3,534 per ounce as markets panicked about supply disruptions. Swiss refineries process the large gold bars that back futures trading and settle international contracts. A 39% tariff would have crippled the global gold market. But then, just hours later, Trump reversed course. Gold will not be tariffed, he posted on Truth Social. Gold futures closed down 2.5%. The entire episode lasted less than 24 hours. Most analysts dismissed this as a policy mistake, but financial insiders saw something else. The tariff announcement was precise. It targeted specific types of gold bars essential to international trading. It hit Switzerland, the center of global gold refining. It was designed to cause maximum market disruption in minimum time. This wasn't random policy confusion. This was market testing. The Trump administration was observing how gold markets react to policy uncertainty. They were gathering intelligence on international gold supply chains and dependencies. They were measuring the speed and scale of market response to US gold policy changes. Most importantly, they were testing whether the US could influence global gold prices through regulatory action alone. The reaction told them everything they needed to know. Global gold markets are sensitive to US policy signals. Swiss refineries cannot easily replace their US market access. Large institutional traders panic when gold supply chains face disruption. The infrastructure for gold revaluation extends beyond regulatory changes to actual market mechanics. When Trump reverses the tariff within hours, he demonstrates that the US can move global gold prices up and down at will. That's the kind of market control necessary for successful revaluation. But the most telling signal came from the proposed US sovereign wealth fund itself. Trump has explicitly stated his intention to create one of the world's largest sovereign wealth funds. Norway, which has the largest fund globally, manages $1.7 trillion. China's fund controls $1.3 trillion. Trump wants to match or exceed these numbers. The fund would focus on domestic infrastructure development, international strategic investments, and potentially major technology acquisitions. The scope is unprecedented for US domestic policy. But where would the initial capital come from? The fund requires massive initial capitalization that traditional revenue sources cannot provide. Nearly 1 out of every 5 tax dollars collected already goes to interest payments on existing debt. Raising taxes to fund a sovereign wealth fund contradicts the administration's stated goal of reducing tax burden and is politically impossible under a Republican-controlled Congress. Borrowing more money to start an investment fund makes no economic sense when you're already borrowing to pay interest on previous borrowing. This leaves gold revaluation as the only viable funding mechanism. $749 billion in unrealized gold value could capitalize the world's largest sovereign wealth fund without raising taxes, without increasing debt, without cutting spending. It's the perfect solution to an impossible funding challenge. Besant and Commerce Secretary Howard Lutnick have been tasked with developing the fund's operational strategy within 90 days. The timeline suggests urgency, the scope suggests ambition, the funding requirements suggest gold revaluation. The mathematical elegance is undeniable. Revalue gold from $42 to market prices and create $749 billion in new government assets. Use those assets as collateral or direct funding for a massive sovereign wealth fund. Deploy the fund to rebuild American infrastructure, secure strategic international investments, and extend US influence globally, all without raising taxes or increasing debt. It's the kind of financial engineering that appeals to a businessman turned president who thinks in terms of leveraging assets and maximizing returns. Yet the limitations are equally clear. While $749 billion is an enormous sum, it represents only a fraction of America's total fiscal challenges. The national debt grows by approximately $1 trillion every 100 days. Unfunded obligations for Social Security, Medicare, and other programs total an estimated $73 trillion. Gold revaluation would provide temporary fiscal relief but cannot solve the underlying structural problems driving debt accumulation. It's a massive band-aid on a hemorrhaging patient. Some analysts suggest far more dramatic scenarios. Financial expert Jim Rickards has calculated that gold would need to reach $27,000 per ounce to properly back the dollar at historic ratios. Investment banker projections show gold prices of $40,000 to $79,000 per ounce in extreme revaluation scenarios. At $79,000 per ounce, the government's gold reserves would be worth over $20 trillion. That's enough to cut the debt to GDP ratio in half overnight. These aren't mainstream predictions, but they illustrate the mathematical possibilities when you control both the gold and the pricing mechanism. The precedent exists for such dramatic moves. When Roosevelt revalued gold in 1934, he didn't just adjust for inflation or market conditions. He engineered a strategic devaluation of the dollar to achieve specific economic outcomes. The 69% overnight increase wasn't gradual market adjustment. It was financial shock therapy designed to break deflationary psychology and restore government fiscal capacity. Modern revaluation could follow the same playbook, but with far larger numbers. However, there's one critical question that nobody wants to discuss publicly. Does the gold actually exist? For decades, speculation has surrounded whether Fort Knox and other government depositories actually contain the gold the Treasury claims to own. The last comprehensive audit of America's gold reserves occurred in 1953, over 70 years ago. The last partial inspection happened in 1974 when Treasury officials opened one vault at Fort Knox for a 2-hour photo opportunity with politicians and reporters. They examined roughly 6% of claimed holdings. That's it, 6% in 50 years. Every other major gold-holding nation conducts regular audits of their reserves. Switzerland audits annually. Germany completed a comprehensive verification program in 2020. But the United States, which claims to hold more gold than any other country, hasn't allowed independent verification in 7 decades. The precious metals community has repeatedly requested audits only to be dismissed as conspiracy theorists for questioning whether the gold exists in claimed quantities. President Trump has previously expressed interest in conducting a full audit of Fort Knox gold reserves. Elon Musk has publicly supported inspection of U.S. gold holdings. The audit question becomes critical before any revaluation because you need to verify quantity and purity before repricing. If the government claims to own 261.5 million troy ounces, but actually owns significantly less, revaluation becomes fraud rather than policy. The audit would serve multiple purposes beyond verification. It would establish baseline measurements for revaluation, potentially expose discrepancies that developed over decades of limited oversight, and provide transparency that could support public confidence in the revaluation process. But here's where the strategy gets interesting. Even if a comprehensive audit reveals less gold than claimed, the shortfall could justify emergency measures to acquire more. The government could invoke national security provisions to purchase gold at current market prices, then immediately revalue all holdings at much higher strategic reserve prices. Any gold acquired at $3,000 per ounce and revalued at $20,000 per ounce still generates massive profits for the Treasury. The international implications extend far beyond US domestic policy. Central banks worldwide have been accumulating gold at unprecedented rates since 2020. China, Russia, India, and other major economies have dramatically increased their gold reserves while reducing dollar holdings. They appear to be preparing for exactly this scenario. A US gold revaluation would trigger a global race to accumulate gold reserves. Countries with large gold holdings would see their strategic assets multiply in value overnight. Countries without significant gold reserves would face immediate pressure to acquire them at newly elevated prices. The ripple effects would reshape international monetary relationships. Oil-producing nations might demand gold-backed payment guarantees. Trade agreements could shift toward gold-settled contracts rather than dollar-denominated terms. The dollar's role as global reserve currency wouldn't disappear, but it could transform from pure fiat currency to gold-backed currency, fundamentally altering how international finance operates. Financial markets have already begun positioning for this possibility. Gold prices have surged toward $3,000 per ounce, partly due to revaluation speculation. Professional investors and institutions are building positions in gold-related assets, anticipating the price explosion that would follow official US revaluation. The smart money isn't waiting for confirmation. They're positioning now while prices remain relatively low compared to potential revaluation levels. But the Federal Reserve represents the biggest obstacle to implementation. Fed Chair Jay Powell has consistently opposed any return to gold-backed monetary policy. The central bank's independence could block revaluation efforts, even if the Treasury supports them. However, Trump's ongoing tensions with Powell create opportunity for change. The recent resignation of FOMC member Ann Kluger following personnel changes at the Bureau of Labor Statistics provides an opening for Trump to install a Fed governor who supports gold revaluation policies. The appointment of a shadow Fed chair sympathetic to gold backing could neutralize Powell's opposition. Federal Reserve governors serve 14-year terms, providing long-term influence over monetary policy. A strategic appointment could shift the balance of power within the Federal Open Market Committee toward officials who view gold revaluation as sound policy rather than dangerous experimentation. Opposition extends beyond the Federal Reserve to include academic economists, fiscal conservatives, and international monetary authorities who view revaluation as accounting manipulation disguised as fiscal policy. Critics argue that artificial price increases undermine confidence in the dollar and could trigger irresponsible monetary expansion once the easy money mechanism is established. They fear that revaluation success could lead to repeated use of the same tool, gradually destroying the currency's credibility through obvious manipulation. International opposition could prove equally challenging. Major trading partners depend on dollar stability for their own economic planning. Sudden revaluation could disrupt existing trade agreements, currency hedging strategies, and international investment flows. European central bank officials have expressed concern about any US monetary policy that could destabilize global financial markets through unilateral action. Yet the Trump administration appears determined to move forward despite opposition. The timeline suggests implementation could occur within 12 months of the Sovereign Wealth Fund announcement. August has been identified as a potential announcement month, following historical precedent set by Nixon's gold window closure on August 15, 1971. Summer announcements minimize immediate market disruption when trading volumes are reduced and attention is focused elsewhere. The practical mechanics of implementation involve existing legal frameworks that grant significant discretionary authority to the Treasury Secretary. Title 31, Section 5117 of the U.S. Code stipulates the legal gold price but includes provisions allowing the Secretary to prescribe regulations with presidential approval. The recently amended Financial Accounting Manual provides operational guidance for issuing gold certificates to monetize government gold holdings. The infrastructure for revaluation already exists within current government systems. The Treasury owns the gold, part of which is offset by gold certificates issued to the Federal Reserve at the statutory rate. The value of gold certificates is recorded in the Treasury's cash balance, known as the Treasury General Account. This existing system provides a direct pathway for revaluation without requiring complex new financial instruments or lengthy congressional approval processes. But timing remains everything. The revaluation must occur when political conditions allow decisive action, when market conditions minimize disruption risk, and when international circumstances provide maximum strategic advantage. Trump's team appears to be preparing for all three conditions to align simultaneously, creating the perfect moment to execute the largest financial operation in American history. The execution window is narrowing rapidly. Every indicator points to preparation phases accelerating toward implementation. While the public focuses on daily political theater, financial insiders are watching something far more significant unfold behind the scenes. The pieces aren't just moving into position anymore, they're locked and loaded. Consider the coordination required for an operation of this magnitude. Gold revaluation isn't a policy you announce on Monday and implement on Tuesday. It requires months of preparation, legal framework adjustment, market positioning, and international coordination. The May amendment to the Federal Reserve's accounting manual wasn't random bureaucratic updating, it was preparation. The August tariff testing wasn't policy confusion, it was rehearsal. The February sovereign wealth fund announcement wasn't campaign rhetoric, it was declaration of intent. Now examine the personnel positioning. Scott Bessent isn't just any Treasury Secretary. He's a former hedge fund manager who understands market mechanics, leverage, and timing. His background includes working for George Soros, the man famous for breaking the Bank of England by betting against the pound. Bessent knows how currency markets react to government actions. He understands the difference between gradual policy adjustment and financial shock therapy. When he talks about monetizing the asset side of the balance sheet, he's not speaking in theoretical terms. He's describing specific operational plans. Howard Lutnick, the Commerce Secretary, brings complementary expertise. His background running Cantor Fitzgerald gives him intimate knowledge of bond markets, trading systems, and institutional finance. Together, Bessent and Lutnick represent exactly the skill set needed for complex financial operations that span Treasury policy and market implementation. This isn't accidental personnel selection. This is strategic team building for a specific mission. The timeline becomes clearer when you understand the constraints they're working within. The Sovereign Wealth Fund initiative has a 12-month implementation target. But creating a fund of this magnitude requires initial capitalization that must be secured before operational launch. You can't announce a $1 trillion sovereign wealth fund without demonstrating where the money comes from. Traditional funding sources are politically impossible and economically irrational. Gold revaluation is the only mechanism that generates the required capital within the required timeframe. This means revaluation must occur significantly before the fund's operational launch. If the fund needs to be functional within 12 months, revaluation needs to happen within 6 to 8 months. That puts the operational window somewhere between late summer and early fall. August remains the most likely month based on historical precedent and market conditions. But here's what most people miss about the implementation mechanics. Revaluation doesn't happen in isolation. It's part of a coordinated sequence that includes multiple policy changes designed to reinforce each other. The sequence likely begins with the comprehensive audit of gold reserves that Trump has previously discussed. The audit serves multiple purposes beyond simple verification. It creates public awareness of America's gold holdings, establishes the baseline for revaluation, and provides justification for treating gold as a strategic national asset rather than an obsolete relic. The audit phase also allows time for quiet accumulation of additional gold reserves through mechanisms that don't trigger market attention. Government agencies can purchase gold through intermediaries, accept it as payment for fines and penalties, or acquire it through asset forfeiture operations. The goal isn't necessarily to dramatically increase total holdings, but to ensure maximum flexibility during revaluation. Following the audit comes the legal preparation phase. While existing statutes provide authority for revaluation, implementing an operation of this scale requires detailed regulatory framework. The Treasury needs specific procedures for certificate issuance, Federal Reserve coordination, and market communication. These preparations happen quietly, but leave documentary traces for those who know where to look. The market preparation phase involves coordination with major financial institutions that will be affected by revaluation. Large banks, investment funds, and international trading partners need advance warning to prevent system-wide chaos. This doesn't mean revealing exact timing or pricing, but it does mean ensuring that critical financial infrastructure can handle the operational demands of massive price adjustments. Finally comes the implementation sequence itself. Based on historical precedent and current conditions, this likely begins with weekend announcement to minimize immediate market disruption. Currency and commodity markets operate continuously, but most institutional trading occurs during business hours. Weekend announcements provide time for initial market adjustment before full trading resumes. The announcement itself would follow Roosevelt's 1934 playbook, but with modern modifications. Rather than confiscating private gold holdings, the focus would be entirely on government-owned reserves. The message would emphasize strengthening America's financial position, restoring monetary stability, and providing resources for national investment. The revaluation would be presented as returning to sound money principles rather than abandoning them. The immediate market reaction would be dramatic but predictable. Gold prices would surge toward the new official valuation level. Dollar values would fluctuate as markets adjust to the new gold-dollar relationship. Stock markets would experience volatility as investors repositioned portfolios based on changed monetary conditions. Bond markets would face particular stress as revaluation implies future inflation that erodes fixed income returns. But the real impact unfolds over months rather than days. As gold prices stabilize at dramatically higher levels, the psychological effect on markets becomes profound. Assets perceived as inflation hedges would attract massive investment flows. Real estate, commodities, and foreign currencies would see increased demand as investors seek protection against dollar devaluation. The economy would enter a period of significant repricing as all asset values adjust to new monetary reality. The inflationary consequences represent both the greatest risk and the greatest benefit of revaluation. Inflation erodes the real burden of government debt while destroying the value of dollar-denominated savings. For the government, this is feature rather than bug. $36 trillion in debt becomes far more manageable when paid back with dollars worth significantly less than when originally borrowed. The mathematics are elegant from a fiscal perspective, but devastating from a saver's perspective. Historical analysis suggests inflation following major monetary adjustments typically peaks between 18 and 36 months after implementation. The 1970s experience following Nixon's gold window closure provides the relevant precedent. Inflation accelerated gradually at first, then spiked dramatically as psychological expectations shifted. Food, energy, and housing prices led the increase, as these represent necessities, where demand remains relatively constant regardless of price. The Federal Reserve would face impossible choices during this transition. Traditional monetary policy tools become ineffective when the fundamental basis of the monetary system changes. Raising interest rates to combat inflation becomes politically impossible when higher rates increase government debt service costs. The Fed's independence, already under pressure from political interference, could face complete subordination to fiscal policy requirements. International reactions would vary based on each country's gold holdings and dollar exposure. Nations with substantial gold reserves would benefit enormously from revaluation. China's estimated 4,000 to 6,000 tons of gold would increase dramatically in value. Russia's gold accumulation program would prove prescient. European nations with significant holdings would see their strategic assets multiply overnight. Countries without substantial gold reserves would face immediate disadvantage. They would need to acquire gold at newly elevated prices or accept reduced relative wealth compared to gold-holding nations. This creates powerful incentives for immediate gold accumulation, driving prices even higher in a self-reinforcing cycle. The oil market represents a critical battleground for international monetary adjustment. Petroleum-producing nations currently accept dollars for oil exports based on the dollar's reserve currency status. But if the dollar's value becomes uncertain due to revaluation and potential future inflation, oil producers might demand alternative payment arrangements. Gold-backed payment guarantees could become standard for large energy transactions. China's response would be particularly significant given their role in global trade and their suspected gold accumulation. If revaluation confirms gold's renewed importance in international monetary arrangements, China could accelerate their own gold-backed currency initiatives. The yuan's role in international trade could expand rapidly if backed by substantial gold reserves while the dollar faces devaluation pressure. The technological sector would experience unique impacts from revaluation. Major technology companies hold substantial cash reserves that would lose purchasing power through dollar devaluation. But technology assets themselves might appreciate as investors seek alternatives to cash holdings. The proposed sovereign wealth fund's potential acquisition of companies like TikTok becomes more feasible when funded through revaluation rather than borrowing. Regional banks represent the most vulnerable sector during revaluation transition. These institutions typically hold substantial government bond portfolios that would lose value as inflation expectations rise. Their commercial real estate loan portfolios would face additional stress as property values adjust to new monetary conditions. The banking sector consolidation that began with Silicon Valley Bank's failure could accelerate dramatically. The political implications extend far beyond economic policy. Successful revaluation would demonstrate that alternative monetary arrangements remain viable despite decades of fiat currency dominance. This could inspire other nations to explore gold-backed or commodity-backed currency systems. The Bretton Woods international monetary system that collapsed in 1971 could experience partial resurrection through renewed gold backing. Domestic political reactions would likely follow partisan lines initially. Republicans would support revaluation as restoring sound money principles and reducing debt burden without tax increases. Democrats would oppose it as regressive policy that benefits wealthy asset holders while harming middle-class savers. But if revaluation successfully funds major infrastructure investment through the Sovereign Wealth Fund, political calculations could shift rapidly. The implementation timeline suggests the critical decision point approaches within months rather than years. All preparation phases are either complete or nearing completion. Legal frameworks exist, personnel are positioned, market testing has occurred, international conditions favor bold monetary policy action. The only remaining question is whether political will exist to execute the largest financial operation in American history. For individual Americans, the implications are stark and immediate. Dollar-denominated savings would lose substantial purchasing power. Fixed income investments would underperform dramatically. Real assets like real estate, commodities, and foreign currency holdings would provide better inflation protection. The wealth gap between asset holders and cash holders would expand dramatically. The strategic timing becomes apparent when you consider alternative scenarios. Waiting longer increases the risk that international competitors implement their own gold-backed monetary systems first. Delaying action allows debt service costs to continue growing, making fiscal problems even more severe. Market conditions that currently favor revaluation might not persist indefinitely. But the most compelling argument for immediate action is mathematical inevitability. The current fiscal trajectory is unsustainable regardless of political preferences or economic theories. Interest payments that exceed defense spending and approach Social Security levels cannot continue indefinitely. Traditional solutions have proven politically impossible. Gold revaluation represents the only viable path forward that avoids default while maintaining government functionality. The countdown has begun whether Americans realize it or not. The question isn't whether dramatic monetary policy changes are coming. The question is whether you'll be positioned for the transition when it arrives. The preparation phase reveals itself through seemingly unrelated policy moves that form a coherent pattern when viewed together. Consider the recent amendments to federal banking regulations that expand the Treasury's authority to issue gold certificates. Consider the quiet personnel changes at key regulatory agencies that place gold-friendly officials in critical positions. Consider the international trade negotiations that increasingly emphasize bilateral currency arrangements rather than dollar-denominated contracts. These aren't random policy adjustments. They're coordinated preparation for a monetary system that operates fundamentally differently than the current arrangement. Every piece serves a specific purpose in the larger strategy. Every appointment strengthens the team capable of executing complex financial operations. Every regulatory change removes potential obstacles to revaluation implementation. The Federal Reserve's resistance becomes less relevant when you understand the legal mechanics involved. While the Fed maintains operational independence for traditional monetary policy, gold revaluation falls under Treasury authority through existing statutory provisions. The Secretary of the Treasury doesn't need Federal Reserve permission to revalue gold certificates or adjust the official gold price. The Fed's role becomes largely administrative rather than decisional. This explains why Powell's opposition matters less than many analysts assume. The Federal Reserve can complain about revaluation policy, but they cannot prevent it under current legal frameworks. Their influence operates through market communication and implementation details, rather than veto power over basic policy direction. A determined Treasury Secretary with presidential backing can execute revaluation despite Fed objections. The international coordination aspect becomes visible through diplomatic channels that most people never monitor. Treasury officials have been conducting quiet consultations with counterparts in major gold-holding nations. These discussions don't appear in public schedules or official announcements, but they're essential for managing the global disruption that revaluation would create. The conversations likely focus on implementation timing, market coordination, and mutual support during the transition period. Countries with substantial gold reserves have strong incentives to support US revaluation because it increases their own strategic assets. Countries without significant gold holdings face difficult choices about how to respond to the new monetary reality. China represents the most complex negotiation because their gold holdings remain officially undisclosed, while intelligence estimates suggest massive accumulation over the past decade. If China holds 4,000 to 6,000 tons, as analysts believe, revaluation would provide them with enormous financial resources, just as trade tensions with the United States intensify. The timing creates both opportunity and risk for American strategic interests. Russia's position is clearer because their gold accumulation has been transparent and systematic. They've reduced dollar reserves while increasing gold holdings, specifically in preparation for scenarios like revaluation. Their support for US gold policy would be automatic because it validates their own monetary strategy while providing immediate financial benefits. European responses would vary by country based on individual gold holdings and economic relationships with the United States. Germany's substantial reserves would make them natural supporters despite any philosophical objections to dramatic monetary policy changes. France's traditional preference for gold-backed monetary systems would align with revaluation objectives. Switzerland's role as the global gold refining center would provide them with unique benefits, regardless of their official policy position. The oil market negotiations represent perhaps the most critical international element because energy pricing affects global inflation more than any other single factor. If major oil producers demand gold-backed payment guarantees following US revaluation, the inflationary impact would accelerate dramatically. Conversely, if they continue accepting dollars backed by gold rather than pure fiat currency, the transition becomes more manageable. Saudi Arabia's position becomes pivotal because their oil pricing decisions influence the entire global energy market. Their recent openness to accepting currencies other than dollars for oil payments suggests preparation for exactly this type of monetary transition. The US-Saudi relationship that has anchored the petrodollar system since the 1970s could evolve into a petrogold arrangement that serves both countries' strategic interests. The domestic preparation involves more than just legal and regulatory changes. The Treasury has been quietly increasing its operational capacity for large-scale gold transactions. Personnel with precious metals expertise have been transferred to key positions. Trading systems have been upgraded to handle the volume and volatility that revaluation would create. Physical security at gold storage facilities has been enhanced. These operational improvements suggest implementation planning has progressed beyond theoretical discussion to practical preparation. You don't upgrade gold trading systems unless you expect to use them extensively. You don't enhance vault security unless you anticipate increased attention to physical gold holdings. You don't transfer precious metals specialists to senior positions unless their expertise will become critically important. The market positioning by sophisticated investors provides another indication of timing. Large investment funds and family offices have been quietly accumulating gold-related assets throughout 2025. These aren't retail investors following internet advice. These are institutional investors with access to high-level government and financial industry contacts. Their positioning suggests they expect major gold price movements within months rather than years. The options market activity tells a similar story. Unusually large positions in long-term gold call options suggest professional investors are betting on dramatic price increases during specific time periods. The concentration of these positions around late summer and early fall expiration dates aligns with the August implementation timeline that historical precedent suggests. The signs are unmistakable. The timeline is accelerating. The infrastructure is in place. Trump's gold revaluation isn't a distant possibility anymore. It's an operational plan moving toward execution. Whether you see this coming or get blindsided by it will determine your financial future. The countdown has already begun.